Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. The G20 meeting is underway in Argentina, and already this morning, the US, Canada, and Mexico have announced that they have signed a trade agreement earlier this morning. We enter the weekend with lots of optimism on the part of traders in anticipation of a potential agreement between the US and China as far as trade is concerned. And we can see coming off of the March corn contract the strength that the market has had this week. March corn has bounced off of support along the 369 quarter number, which is 2 standard deviations below our point of control of 404. The market now looks to make its way up to potential resistance that lives at 381.5. And if the market's able to get through that number, a potential run up to about 395 is plausible for corn. It remains to be seen what happens over the course of the weekend, but for now, the market looks like it wants to potentially be a bit bullish. Early in September, the market made a significant low, followed now by a new higher low. And if this higher low at 370 is able to hold, we do anticipate at the very least that the market can make a run back up to about 390, where resistance once lived in the past. We can see where support resistance level 5 indicator had posted right up against volatility-based support for the market at 367.5. And from this level, we can see where the market has then been able to make its way up. The first area of potential resistance that we would be looking at is the 270-degree mark at 376.5. But the market looks to be making its way through that level. So now the key area of resistance above would be at volatility-based resistance that ranges from 387.25 to 393.75. If and when this market's able to make it up through this region, this is where we would anticipate our first level of key resistance to live, with the potential overhead target sitting at about 396. The caveat would be if the market were to make a run and if the announcements over the course of the weekend between China are negative, we think then that the market could very well find resistance up at the 382.5 number, at which point the market would then look to make its way back down and potentially retest previous lows near 355 to 360. Soybean futures is on the precipice of a potential breakout. We can see from the soybean chart pattern that the market made a significant low several months ago, followed by a higher low that came in at the 841 number, and then it has recently made a snapback reversal coming in over the course of the last couple of days. The market now is testing overhead resistance near 895.25. And if the market's able to clearly break above this 895 mark, we have the potential for the market to have a breakout run overhead that goes up to test somewhere in the neighborhood of 930. In the event of a breakout up to the 930 number, this is where we'd look for the market to find a bit of resistance. But what is going to be key if this market's going to be able to make a breakout to the upside is perhaps the response after the negotiations post the G20 meeting this weekend. The snapback reversal and the big move that we saw over the past couple of days is perhaps the result of managed money exiting positions and wanting to take a risk-off approach ahead of the negotiations that are presumed to be taking place over the course of the weekend with China. Once announcements are able to start coming through from the negotiations, the market will perhaps make a bit of a run to the upside. The alternative then would be if there are no agreements made over the course of the weekend, the market can potentially continue to find resistance near the 895 to 900 mark, and at which point we would see a nice move to the downside in response to the lack of news or the lack of progress with regard to agreements with China. The previous high of 905 for the January beans contract was significant, and we can see that this has been very good resistance. But as mentioned before, the subsequent 3 higher lows is a pattern of potential strength for the market. And if we're able to clear this 895 number with good strength, we anticipate a nice move to the upside that perhaps makes a run up to about 930. We've discussed in the past that the March contract for wheat had a time factor coming in on November 30th, and we can see that this November 30th timeline has given us a very big move to the upside. Over the last 2 weeks, we can see that the market had been in a range-bound formation, But in particular, one of the things that we had discussed was the potential for the market to remain sideways until it comes into our arc cycle swing. And upon touching the cycle swing, that the market could find itself in a position where it starts to trace this way up and potentially make its way up to about 550 to 555. This appears to be what is occurring, especially if this market's able to make a close next week above the 525 point of control level that lives right above as potential resistance. This area had been a very good area of resistance previously, but now that the market has made its way down and now found support and looks to find its way back up again, this 525 level looks to be very critical for the March week contract. In addition to the 525 mark being important, we also have our 360-degree mark at 529. And if this market is able to close above 529 next week, we anticipate then that a potential run up to about 550 is plausible. And part of the reason why we believe that is we have a very important timing angle coming in for this market here. You notice that the market has remained below this level for quite some time, and now time and price are coming together. And when that occurs for us, we believe that a potential change in trend could very well be in play. Here we can see where our time factor low came in and played a key role in helping us identify a potential turning point. And it was not until the market hit this time factor that we're beginning to see some good potential strength coming in to the upside for this contract. Again, upon being able to close above this timing line, it's going to be very important to see the way in which this market responds going forward. And we have some very key levels overhead that suggest that a run up to about 550 is plausible for the March week contract. For the last several weeks, the US dollar has found support at 96 below and resistance at 98 above. But what's particularly key for the US dollar is the fact that it has been making subsequent higher highs and higher lows. After having made the significant low in September, it made its next subsequent high. Then we have 1, 2, 3 higher lows coming in over the last several months. This is a potential indication of strength, given that the fundamental definition of an uptrend is higher highs and higher lows. With this market then having come in, we thought that there was the potential for the market to find some resistance somewhere near the Fibonacci 78.6% resistance level of 97.34. We're looking at the drop that the market had made most recently, and if the market had not been able to get above this 97.34 number, the potential for next leg down was there. That would have been the first sign of potential weakness for the market. Instead, what we found is that the market did find resistance near that 97.34 number, but made another higher low potentially given the strength of the advance from Friday. If this market is now able to break above the previous highs, we do think that the US dollar is poised to make a potential run overhead somewhere in the neighborhood of 99 to 100. So it's going to be key next week to see if this market's able to break back above these previous highs that it had since posted. If the market instead simply reverses back on Monday, then we would look for a first test somewhere in the neighborhood of 96 with the potential of the market coming back down to 95. But this 97.34 number is going to be very key for the US dollar in the near term. As we close out with the crude oil market, we can see that this contract has been in a very strong downtrend for quite some time now. Part of where we can see the downtrend occurring is that the market continues to make downside moves, followed by sideways consolidations, followed by another subsequent downside move, and each of the sideways consolidations fail to breach the lows of the previous consolidation. And so in essence, what we're looking at are movements that look like small B's that keep occurring one after another. So the market breaks down, gives us a sideways consolidation. The market breaks down, gives us a sideways consolidation. The market breaks down, gives us a sideways consolidation. We get another breakdown, and then the market gives us another sideways consolidation. Eventually, this pattern is going to terminate. And once this market terminates this pattern, this is what we would view as an opportunity for a corrective upside move, which does not change the direction of the trend, but instead gives us insight as to where this market may give us a bounce. So if this market does not give us a downside break from this sideways consolidation that we're looking at, alternatively, if the market were to make its way back up, we would then be looking at the possibility of either an upside consolidation or the possibility of continued strength to the upside up against resistance. The first key area of resistance that we would look for is somewhere in the neighborhood of $58 to $60. And if the market's not able to get through this area, from this point, we think that the market has a reasonable shot of making another leg to the downside. In either case, we're not looking to get in front of this rolling bus, as the crude oil market has been in a very strong downtrend as of late. And so we'll simply continue to monitor to see if it's able to reverse the downside pattern that we've been seeing most recently. Thank you so much for joining us for our regular market update. Look forward to touching base with you again next.